You are listening to Retire Texas Style, the podcast. We appreciate you joining us.
You know, as much as we think Wall Street is doing well, it seems that these are not good days on Wall Street. Get this, since July, the percentage of stocks that were above 200-day moving average plummeted by more than 40%. The big tech companies like Tesla are down by as much as 50%. Other big companies like Target, Southwest Airlines, and even Disney have slumped to about 60%. Here's market strategist Troy Gaske of Fox Business.
Our whole contention since the end of 21 is that returns are going to be much harder because interest rates clearly aren't going lower like they did from 1982 to 2021. And the Fed is going to be tightening policy until either we have a recession or inflation gets sustainably below 2%, which is much harder given how tight the labor market continues to be. It's a time to be defensive. It's a time to protect capital. It's not a time to be a hero.
So it's a time to be defensive is what he says here. So should portfolios be in a protection mode right now, or do all these low numbers present kind of an opportunity to get back into the market, Steve?
Well, Jess, I think that when you don't have time on your side and you're close to retirement, you don't have time to risk it. You know, I talk so much about the rule of 100, which means basically if you're my age, if you're 60 years old, you should have no more than 40% of your money at risk. And I mean, that's in your 401k, everything that you have. And you know, people come to see me and they have 96% of their money at risk in their 401k and it's volatile and they're losing it and the fees are wiping it out. So, you know, we can talk everything about all the, you know, these magnificent 7 stocks that are all down, Microsoft, Apple, Nvidia, Meta, Amazon, Tesla. But what really matters is not those stocks, what's happened on Wall Street, what's happened in Washington, D.C. What matters is what's happening on your street, happening at your house. Because, you know, Jess, people come to me and say, well, you know, my company lost all my money or my 401k lost all my money. Well, let me tell you something. I tell people, you need to take responsibility for your actions about this. You need to partner with somebody else, somebody like us. Sit down, a complimentary review. Let's figure out where you are, where you want to go, and what it takes to get there. You know, what is the gap factor of your plan, Jess? You know, we're going to look at all the different things, but, you know, Jess, when you're 59 and a half, you can all of a sudden take control of your retirement monies. You can do something with it. You can make sure that the fees are low. You can make sure it's out of harm's way. We were talking earlier in the show about a great income plan. Well, a lot of people come to me and say, Steve, I have this money. I want upside exposure, but not downside risk. And we do that for people. You know, right now we have a strategy that we've shown lots of our clients that year one, it has 9% fixed. So whether you put $3 million or $100,000 in there, for year one, you're going to make 9% for the whole year. And it's an introductory rate. And then starting year two, we may leave some of the fixed. That fixed rate's probably 3.5%, 4%, but we're going to put the lion's share of it in the S&P 500 point to point with a cap. What that means to you is if the Standard & Poor's goes up 9%, you're going to get 9%. If it goes up 12%, which is the cap, you're going to get all the 12%. But what you're really going to get is when the market is negative, like it was last year, nearly 20%, zero is your hero. So all of a sudden, it doesn't have a fee, you haven't lost any money, but you get to go down there and lock in where the market is and ride back up, but not lose any money. So the bottom line is, Jess, let's just say you put $1 million in this strategy. You know, after 10 years, you've doubled your money based on the recent 10-year period. But what's important is you haven't lost any money. So you get to keep up with inflation, have great returns, but not lose your money. If that's what you're looking for in retirement, is safety, security, coupled with an income strategy we talked about earlier in the show, we can really help you with that. But what I want to tell you is riding this market, having to watch the market at 3 o'clock every day about how much money you made, how much money you lost. Jess, that's a choice that you don't have to participate in. Let us sit down at Hoyle Financial. We've been doing this 34 years. Let us really figure out the plan, because that's what it's about. Did you plan to fail or fail to plan? What I'm going to tell you, when you have the Hoyle difference on your side, We'll make it happen.
Thanks so much for joining us for Retire Texas Style, the podcast. Get more details on the website, retiretexasstyle.com.
Hoyle Financial is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and/or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. Bonus annuities may include higher surrender charges, longer surrender charge periods, lower caps, higher spreads, or other restrictions that are not included in similar annuities that do not offer a premium bonus feature. Read your contract for restrictions, limitations, or penalties. By contacting us, you may be provided with information about insurance and annuity products offered through Hoyle Financial Group, Texas Insurance Licensed 1719183.